Hi everyone, this is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but he comes highly recommended from my contacts in Europe and our European listeners. His name is Willem Middelkoop, and he's founder of the Commodity Discovery Fund and a writer of many popular investment books. I'll quickly read his bio. He started a bullion company, and he sold it. I think it generated over 100 million euros per year in sales before he sold it, and he did it, I think, in less than 6 years. He's a well-known personality in the Netherlands for his work as a stock market commentator for the Dutch business television channel RTLZ, and he also predicted the onset of the credit crisis in his first book, which translates in English When the Dollar Falls, in 2007. His subsequent books are The Permanent Oil Crisis in 2008, Surviving the Credit Crisis in 2009, Gold and the Secret of Money in 2012, and his newest book is The Big Reset, War on Gold and the Financial Endgame, which I'm excited to read when I get a chance. He has over 100,000 copies of the book sold. Thank you for joining us, Willem.
Yeah, thanks. That's a great introduction.
Now, Willem, you've lived in Europe for most of your life. I believe you were born in Switzerland, and you live in the Netherlands still.
That's right.
What's your opinion of what the ECB is doing? It seems they violated their mandate. They weren't allowed to do QE. It seems the ECB is pissing off the German government with this printing. Do you think they're going to keep doing quantitative easing to try to save their banks?
Well, yeah, actually, it's quite a long story. But if you know something about monetary history, you probably know that we've had hyperinflation in the 1920s after the end of the First World War. We had hyperinflation in Germany. So in Germany, they still have this memory about the hyperinflation. So the German central bank, the Bundesbank, they were always very keen on keeping their money strong, keeping the Deutschmark very strong. But after the reunification of Eastern and Western Germany, there was a political deal in Europe in which the Germans, they had to give up their own currency because the French, they were afraid that the Germans would be too powerful. And so this was the start of the whole Euro project. And within the Euro system, within the ECB, the European Central Bank, the Germans were always very tough supporters for a very strict monetary policy. But after the start of the credit crisis, in which, of course, the central banks had to open the floodgates of money to provide liquidity to the system, there was an enormous influence from the Federal Reserve and others on the ECB to also loosen their monetary strategy and to allow the money to flood the system. And especially after the Federal Reserve had their first QE1 and QE2 operations, there was a very strong upwards pressure on the euro, so the euro started to gain in value, which was very negative for European exporters. So that's why the ECB also had to start their own QE, especially also because we have a recession in Europe. Most countries, they're in a quite dire situation after the start of the credit crisis in 08-09. So this all has caused the Germans the Germans are only one of 17 countries within the ECB, the European Central Bank, and every country has one vote. And the Germans, they don't like the current ECB policy, but they're just a minority at this moment.
Yeah, it seems there are certain special interest groups in Germany who do like the euro. The whole thing with Keynesian economics is it's basically mercantilism. They want a cheaper, weaker currency in order to do exports. But the German people don't like the euro. They don't want a weak currency. They want more purchasing power for their money. But Willem, it seems like these central banks, they're taking turns. I don't know if the ECB is having conference calls with the Federal Reserve and the Bank of Japan, but it just seems to me like almost as soon as the Federal Reserve, temporarily stopped the quantitative easing program, at least publicly said, we're cutting back with tapering, that, Japan announced their quantitative easing program, their massive one, another one, and then, Japan stopped a little bit, and then the ECB started, and it seems we're on like this carousel where these three major central banks, whether it's Japan or Europe or the United States, they're all going to take turns printing money, either devaluing their currency against one another or bailing out their banks or things like that. And is this what you see as well?
I think you could say there's a coordinated effort worldwide to keep as much liquidity in the system as needed. Deflation is the worst that can happen to a debt, to a system full of debts. So central bankers, they have made clear since 2002 already, famous speech by Ben Bernanke. So they made clear that a situation of deflation just can't be accepted. So that's why they have to flood the system to create artificial inflation. And I think it is a coordinated effort, and that's why the ECB is also active in the same way.
Yeah, I agree. There's definitely a coordinated effort, and I don't know if you're familiar with currency swaps, but I cover a lot of these on my podcast, and I found out from a friend of mine, a local money manager in the DC metro area, over this past summer. He went to an IMF meeting, he snuck in the back and took notes. And, these central bankers is not something they're going to say in public, but there was pretty much representatives there from all the major governments, all the major economies of the world, and they were talking about nonstop how they're doing all these currency swaps to put liquidity in the system. So even if there's not, stated quantitative easing programs that these governments are doing, so it's either the U.S. is doing currency swaps, I think, with the ECB to prevent some of these European banks, the large ones like Deutsche Bank and stuff like that, from collapsing and creating contagion in the derivatives market. I think the U.S. and Japan are doing currency swaps. I think they're coming up with, new creative. I don't like this because I think deflation is a good thing in the long term. I want more purchasing power for my money. I'm not drastically over leveraged on my personal balance sheet. I'm not, crazy amounts of debt. But these Keynesians they just hate deflation so much, I guess, that, maybe 15, 20 years ago when there wasn't that much debt in the system, it was fine that deflation, it wouldn't have destroyed everything. But now, everything's so massively over leveraged, they've just allowed with central banking so much more debt in the system that, they just seems that they can't allow the free market to work. Although, I'm a free market person, I would love the free market to actually be allowed to work and correct things.
Yeah, but as I said before, when you have too much debt in the system, deflation is, it causes disaster. So when you have deflation, is very nice for the general public because their savings, the purchasing power of their savings increases. But if you have debts, deflation is the worst that can happen to you. So if you have too much debt in the system, you need inflation to inflate away your debts, and that's what the central bankers try to do. I think they won't succeed, and I think we'll enter a period in which we'll have debt restructurings. I talk about debt restructurings in my book, and we also have seen a report coming from the economists within the IMF talking about the need for debt restructuring. So I think that's the next phase of this crisis.
Now, speaking of debt restructurings, Willem, do you think Greece will leave the euro? And what about Germany? Do you think the German people will eventually put enough political pressure maybe on the German politicians to where they say, we're fed up with, having to carry the load for Greece and Portugal and Spain, the pigs countries? And what do you think are probabilities then of Greece leaving the euro and Germany leaving the euro?
I think it's quite hard to imagine Greece leaving the euro. And this has a geopolitical reason. Putin, as you might know, there's a full-out economic war between the West and Russia, especially the US and Russia. And part of this economic war, you have the collapsing oil prices, the collapsing ruble value. But Putin tries to weaken the Western front by having one or two countries leaving the euro system, and then Putin would love a situation in which Greece is stepping out of the euro system, and he can welcome them, and he can give them some financial aid together with China. So I think most Western politicians, they understand this risk. So the Germans and the Dutch, they will have to accept that more and more of their money will travel to the south of Europe and to Greece in particular, given these special geopolitical circumstances.
Now, you mentioned Putin there, and I agree with you about the economic warfare. I think when I look at supply and demand, you say you invest in your fund into oil. It just seems to me when I look at supply and demand, there's not a big real oversupply of the oil market, so I don't really see any fundamental justification whatsoever for this drop in oil price. Do you think then that this was part of economic warfare then, where the U.S. government or the Saudis then, that maybe they didn't like how Russia was teaming up with Syria and supporting that regime over there? Do you think then that this was economic warfare for why the oil price fell?
According to my sources, the fall of the oil price, which started as a nice technical correction, but it really the oil price dropped by 50%, and this can only be explained by some form of manipulation of the futures market. Because like you said, if you study the fundamental factors of the oil market, the supply and demand situation, there's only a surplus, as you said, of 1.5, maybe 2 million barrels per day in a market which consumes over 90 barrels per day. So this is a very small surplus, and that can't be a reason for the 50% decline in worldwide oil prices.
Yeah, I agree. Without going into too much detail, I mean, the shale oil companies here, I really don't know anyone globally who's making any money producing oil except for maybe the Saudis, and a lot of their profits from oil have evaporated. So basically it seems like almost everyone producing oil, maybe they have a few wells here or there that are profitable, but the overwhelming majority of global oil production now is extremely unprofitable. Yeah,
I think the average production cost for a barrel of oil in the US now with oil shale is $75, and I think the oil shale or the oil sands production in Canada, they can't be produced profitable under $60 per barrel. So this is a situation which can't go on, and we expect oil prices to return towards $60, $70, $80 within the next 12 to 18 months. And in our fund, we're buyers of oil under $50. So as soon as the oil price drops beneath $50 level, we add to our position, and we're now long around 70,000 barrels of oil.
That's good. Yeah, I think that's a reasonable estimate there for the oil price. I think about 12 months, I think oil's be somewhere between $65 and $90 a barrel, and I think that's a price where producers, most of them at least, can make some money, and it's not going to be a humongous tax hike on consumers consuming oil. But I think that's more a sustainable price than the price we have now. And clearly, if the oil price spikes to a lot higher price, say $150 a barrel, that's not sustainable either. I don't think the global economy can deal with oil prices if they're too low or too high.
Yeah, agree.
Now, let's talk about gold. You have a whole chapter in your new book, The Big Reset, on gold and gold price manipulation in the book. Do you think we're headed back to a gold standard?
Well, we see some very interesting developments in the gold market. The most interesting point in recent history is that we've seen huge demand from China. We've seen huge demand from Russia, and it's quite clear that in Russia and China, gold is not just a commodity, but gold is used as money. And especially the Chinese have been very vocal about their wish that the general public in China is 1.3 billion people. There's a real wish through or by the Chinese government that people buy as much gold as they can. So the Chinese, they have. I think the Chinese envision a future in which gold plays a much bigger role. I think the Chinese know that gold is a wonderful asset in times of monetary crisis. Russia is quite clear and has been quite vocal about the need to invest in gold as a hedge for their dollar holdings. And actually, in the last 12 months, the Russians have sold quite a bit of their dollar holdings, the U.S. Treasuries. I think it's around 25-30% of their total holdings they have sold over the last 12 months. And they really added a few hundred tons of gold to their central bank position.
Yeah, and yet the World Gold Council says that global gold demand is at an all-time low. I think it's which is kind of ridiculous, because I don't think they're taking into account any of the real Chinese gold demand numbers. You know, if someone spends 30 minutes of doing their own internet research and they look up Kuz Jansen's research from Bullion Star, who I think he does the best research of anyone out there for the Shanghai Gold Exchange. You know, we don't, in the mainstream financial media, they don't accurately cover any of that research from the Shanghai Gold Exchange. And then people can go, you know, to the Russian central bank, like you said, and they can look up that Russia, I think, is putting almost 100% of their monthly trade surplus money in, although, you know, the oil price has dropped quite a bit, so it's not as much as it used to be, but they were putting at one point almost 100% of their very large trade surplus money from their oil profits into gold. So they were getting out of the dollars and treasuries and into physical gold. And, you know, there's enormous demand in India and the Middle East and the developing world and other countries in Asia. But the Western investor, Willem, and you're in Europe, you owned a bullion company. Are people slowly starting to look at gold and silver as value propositions again? Or at least in the West, it seems that there's a lot of trend traders here in the West that they only, you know, want to buy gold and silver when the chart looks good and it's going up.
Yeah, well, you have the speculators who like to buy gold futures or gold shares or silver futures or silver shares, and then you have the savers who look towards gold and silver as another kind of as another way to stash away their cash. And I think it is very important for people to understand that if you buy a physical gold or silver position, it's a way of cash management. And if you invest in futures or shares, that's all speculation. And what I know from my personal experience, I started my own bullion shop at the end of 2008 and sold it in 2011. And yes, we did 100 million yearly turnover at that time in 2011. I've witnessed personally 3 periods in which savers were really getting quite scared and started to flee to hard assets like gold and silver bullion. And this was after the Lehman crash, so end of 2008, early 2009. And we also saw the same rush towards gold in May 2010 when the Greek crisis started, the first phase of the Greek crisis. And at this, as we speak now, I just had contact with some friends who still work at the bullion dealer. And there's a huge demand since 1 or 2 weeks again for gold and silver bullion. And I think the prices, you know, gold bullion in euros or in dollars dropped 40%, silver bullion down 70%. It's a great time to add to your position.
Yeah, I view physical precious metals, like you said, as savings and insurance. I really don't view buying the actual metal as an investment. If people want to make investments, you know, they should do research on like a royalty and streaming company like Sandstorm Gold or Silver Wheaton or Franco-Nevada or Royal Gold, or they should look at some of the mining companies that have lower production costs and their balance sheets aren't loaded with debt. That's what I view as an investment, you know, because potentially you could get dividends or nice capital gains like that from locking it in. And here in the United States, if you're a U.S. citizen, if you buy bullion and you're trying to get capital gains, you know, you can't lock in a really low long-term capital gains tax rate. on the gold price manipulation, since you cover it so much in your book, do you think we're eventually gonna that the gold price and silver price manipulation is gonna end in some form, like what happened with the London gold pool of 1968?
Manipulations always end. Manipulations of financial markets, they always end. We've seen that over and over again in the last few weeks. We've seen the end of the peg of the Swiss National Bank. They had to give up the peg with the euro for the Swiss franc. This was an artificial peg, so this was a currency manipulation. We've seen the end of the London gold pool at the end of the 60s, late 60s. And the current situation, I think, can be compared to the London gold pool at the end of the 60s. Also, nowadays, the Western central banks, they try to avoid that the gold price is going up too fast, and they try to sell some Western gold holdings, central bank holdings. They have all kind of little rules. We have witnessed it firsthand within our fund. We are not allowed to buy physical gold and silver, otherwise we will lose our permits here in the Netherlands. So we can trade gold and silver paper products within our fund, but we are not allowed to buy it physically. And you see many examples like this in the Western financial system, that investors are scared away from investing in gold and silver. But this manipulation will end, and we see the Russians, and we see the Chinese. They understand the smoke screen, as they call it, surrounding the gold price, and they add to their gold holdings on a massive scale. So it's only a matter of time before gold will be revalued to its real value in money terms.
Yeah, I agree. I think the gold and silver market, I think the paper price, this artificial bear market that's been created the last couple of years since 2011, I think there was more, margin requirements and all these other, and, bad investment bank reports bashing gold, saying gold was worthless, it was in a 6,000-year bubble, or things like that. I think that's all part of the manipulation scheme, but, it'll end just like the London gold pool end. They'll run out of metal at a cheap price, because I think it's a basic rule of economics that when you keep the price of something artificially below what its real market value is, eventually you get shortages of supply. And, I think when you look at the balance sheets of the miners, you can tell that the gold and silver prices, if they went any lower or they stay at these low levels for that much longer, that they were either going to go bankrupt or shut off the mine soon. So it's just kind of like the oil market, although, gold and silver aren't necessarily consumed like oil is, although, silver is used for many thousands of things. But it just seems that, it wasn't sustainable, because we saw the real world demand for the actual metal there, and the supply constraints were just so much for the miners, and all that supply that the miners are producing, it's all needed to me, at least in my research of the market, that, all that physical supply is needed that the miners produce every year.
Yeah, and we just had a news today of another takeover bid for a gold company, which we own some shares in Newstrike, and there was a takeover bid today by another gold company. But this is the third takeover bid for a gold company within our portfolio in the last month. So it's quite clear that the senior gold producers, they think the correction of gold is over, and they try to buy the assets on the cheap. And it's a very smart move to buy undervalued gold assets now for gold producers.
Yeah, I agree. As long as there's not too much debt and the production costs are not too high, because I can't tell you, because of the manipulation in the paper markets, what the price of gold is going to be, a year from now or 2 years from now, because, there's just so many games in the paper market. But I can tell you, over the next 5 to 7 years, the gold price is going to have to go higher, because the miners are just pulling out so much gold and silver that, all the low-hanging fruit from the mines is being plucked right now. So the production costs are the oil price has dropped, but I think that's a temporary with the lower oil price. So I think the oil price is going to have to go back up, and the miners' costs are going to go back up, and their grades are not really improving across the board. So I think over the long term, if people want metal, it's going to cost more money to pull it out of the ground, in my opinion, especially, with every country on earth trying to all devalue their currency and that money sloshing around in the asset markets.
Yeah, but there's still many gold producers within our portfolio are still profitable at these prices. So imagine what will happen with their profits when gold goes up $100, $200, $300 per ounce, which can happen very easily. It can happen in 1 quarter. So we concentrate on the gold producers, which are even profitable at these current prices.
Yeah, a lot of the miners, Willem, I don't know what your opinion is on this, but in my opinion, and I research the miners too, I think they've done a pretty good job of cutting most of the fat that they can without actually shutting down their mines in the last 18 to 24 months. So, they've cut SG&A expenses, they've cut their exploration budgets, they fired a lot of middle management and things like that, and they're not going back to the market for high cost penalty type debt or issuing too many shares if they can avoid it.
Yeah, that's true. But I still believe that gold companies, gold producers, they were profitable. They were in business a few years ago when gold was $600-700 dollar per ounce. So if they were able to be in business with prices around the 700 level, of course they can have a healthy business when gold is trading around 1100-1200. But only they needed to scale down some of their operations and fire some staff, to adjust to the current gold price. But in general, it's a very healthy industry. There's not 1 ounce which is not sold. So it's a very healthy industry.
Yeah, I think the demand for all the physical metal, I think almost all, basically all the metal that's produced by the primary gold miners, primary silver miners, all that metal is spoken for. There's not this, humongous above ground surplus like there is in copper or coal or some of these other base metals, I think, where I think they're going to have a lot of trouble finding new demand for going forward. I think that's not going to be a problem for gold and silver.
Okay, we can do one more.
Yeah. Well, my final question, Willem, revolves around the SDR and financial repression. It seems that the people in the Western world, the United States and Europe, it seems they want kind of a controlled inflation with financial repression so they can keep the bond prices high, prevent banks from failing. And it seems that a lot of them kind of want to transition to the SDR. Do you think this is going to be allowed to happen by China or Russia or other countries or people like in their own country? So United States citizens who are waking up, who are saying to their politicians, we don't want the SDR.
Well, there are 2 main points I try to make in my book, and one is that we need a debt restructuring because of the overload of debts in advanced economies, Japan, Europe, US, and another point is that China and Russia, but especially China, have been quite vocal about their wish for a new world reserve currency. So China really calls for a de-Americanization of the financial system, and the Chinese, they are the great supporters to use the special drone rights by the IMF, some kind of IMF money which has been invented in the 1960s when we had the first crisis around the dollar. And China, they really want the SDRs as a way to price the oil as a new supranational currency. So the Chinese, they don't want to get rid of the dollar in the US. They don't want to get rid of the euro in Europe, but they want to use the SDR as a supranational currency in which commodities can be traded, in which international accounts can be adjusted. And if you read my book, you will find all the evidence there that IMF and China and the US are working together within the IMF to bring this financial system to a next level, to a next phase. But this is all done in secret meetings, and there has been some conferences in the last 12 months. Jean-Claude Trichet, the former president of the ECB, has been involved in this. And if you go to my blog, which is called thebigresetblog.com, you can find the latest information about this. So for me, it's not a question if the SDR will be introduced and if this financial system will move towards a new phase. It's only a question when it will happen. I think it probably will happen before 2020.
Those are very interesting thoughts. Now, we have a lot of libertarian gold bugs who don't think the SDR will happen at all, but it seems to me China is hedging its bets with they may allow the SDR for a number of years before maybe they transition to either their own world reserve currency or a gold-backed trade settlement or maybe a gold standard of sorts in the very long term in China. But that's something we could talk about hopefully on the next interview if we have you back on.
Yeah, wonderful. Okay.
Now, I just want to, for listeners who want to buy your book, where can they find your book?
Oh, it's very easy. If you go to Amazon.com and look for The Big Reset, you will have it delivered to your home in a few days.
And about your fund, can Americans also invest in your commodity discovery fund, or only?
You have a wonderful SEC, which doesn't allow U.S. investors to invest in funds like ours in Europe. So we can accept international investors, but not from the U.S., unfortunately.
Well, that makes perfect sense.
Okay.
Unfortunately, we have so much rules and red tape here with the SEC, but that's another show.
Yeah.
Okay, well, thank you very much for your time, Willem. I enjoyed the discussion, and hopefully we can have you back on soon to discuss more of these interesting topics.
Okay, wonderful. Thank you, Jason. Success.